Well, the HDFC Bank stock is getting smashed after results yesterday, Vishy. 6% down as we speak. We are at open at the moment. And we're going to try to break down three key reasons that the earnings were a miss. So, Vishy, let's start off. NIMs at 3.4. Something around 3.6, 3.7 were expected, on the higher side 3.8. What's really gone wrong?
Yeah, so Hersh, a bunch of things that went wrong on the operational front. You've seen the net interest income not rise as fast as the market had expected, about 4% on a quarter-on-quarter basis, as opposed to what the expectation was about 8%. So that is obviously playing into the minds of the investors, as well as, of course, on the net interest margin side. What you're also seeing is that deposit growth is not that strong. So this NIM flat is a bit slightly surprising to me, at least, but net interest income for not growing as fast is further surprising to me. On the other hand, you've seen provisions take over during this quarter, about 1,200 odd crore worth of additional provisions that the bank has made for the AIF portfolio. These are all actions that are sort of playing into the minds of the investors as well as the results themselves.
Yeah, absolutely. And Vishy, one quick point here. You know, your borrowing in HDFC Bank was at 8% prior to merger. That's gone up to 21%.
Yeah.
So what the management seems to be suggesting is, as this comes down from 21 back towards 8, they're not saying it'll come back to 8, but towards 8, margins may recover.
Yeah.
But in your view, how long will this take? 2 quarters, 3 quarters?
This is not a 3-quarter story. This is going to take a while, because when HDFC Limited was getting merged into HDFC Bank, so this was one of the concerns that most people had, was that HDFC Limited has a huge borrowing portfolio. If that comes onto the HDFC Bank book, how fast can you replace those borrowings with deposits? Now, on the deposit front, if you see during the third quarter, the bank added about 41,000 odd crore worth of net deposits, of which you've seen the retail deposit about 53,000 crore, and then some reduction on the bulk front, so obviously the net becoming 41,000 crore. This is lower than the 1 lakh, 1.5 lakh crore sort of trajectory that the bank had guided for earlier.
Yes.
On the other hand, your branch network is also slowing down.
Yes, that's a key.
So that per year about 1,500 branches was the sort of guidance given by the bank, and this year they're doing about 800,000. So it doesn't look so great on the deposit accretion front. So if you want to replace those borrowings, you need to be aggressive on the deposit front. And this is a market where everybody's aggressive. Everybody is raising rates. Everybody's trying to quote the depositors to get the money back.
Sure, and they've guided for 18 to 20% incremental market share in deposits. Deposit growth is slow in the system. Liquidity is tight at the moment. Can they continue to do that, given the fact that they've reduced their branch count guidance from 1,500 to 1,000? So that's one big surprise that's come through. The branch count reduction, it came as a big surprise to me at least. And the other piece was, can they do the 18 to 20% incremental market share in deposits?
Yeah, so that's going to be a challenge, because at this point in time, private sector banks in general are seeing slightly slower deposit accretion. Your public sector peers are far better and are attuned to getting those deposits in, right? They've got a captive customer base. They're also very good at acquiring a new customer set. On the private bank front, you still need to see what exactly happens there, because to cover that additional deposit, you need to raise rates significantly. And remember that they also need to keep the cost of that deposit in mind. So that would mean that they need to push up CASA. Now, for a very long time, we have seen CASA rates hovering about 2.53% range. Could there be a case for raising that savings account rate? Maybe. I don't know for HDFC Bank, but maybe for the broader system.
Understood. Last off is on ROAs. No, they aren't normalizing at a 2% mark. Their normalized ROAs are not 2%. In fact, the ROAs are degrowing. EPS has actually degrown for the first time in HDFC Bank's history on a year-on-year basis, mind you. And that's causing a larger knock on the stock as well.
Yeah.
When do you see that recover, normalize? After all the tax adjustments that they make, normalize at that 2% level?
You have to get the operations right. And unless the operational part of the business gets right, you're not going to see that impact on EPS, on ROA, on any other metric that matters for the bank. During the analyst conversation, the CFO of the bank, Srinivasan Vaidyanathan, also pointed out that they are really pushing up on the deposit front. They really need to get those deposits into the bank. So unless that happens, you're not going to see much of an improvement on the financial basis.
Right. The last take with regard to valuations, I won't ask Vishy this because it's a tricky question, but at 2 times price to book, it's probably at an all-time low, Vishy. So valuations have really taken a knock where HDFC Bank is concerned. So despite all of this negativity, valuations look reasonable and cheap, if I can call it that.
Yeah.
But of course, we have to wait and watch for all of these triggers. Three big misses: margins, deposit growth traction, and ROAs.